All right, welcome to the Explainer from TalkTickers. Today, we're diving deep into the Q2 2025 earnings call for SUNation Energy. That's ticker SUNE.
So this quarter was a real head-scratcher. You've got management on the call sounding super optimistic, talking up their big turnaround and all the progress they've made, but then the market just didn't seem to buy it. The stock actually went down after the call. So what gives? Let's get into it.
And this slide, wow, it just lays it all out, doesn't it? On one hand, you have the company's tone, stable, lean, set up to outperform. The CEO, Scott Maskin, was basically saying, hey, we've navigated some really treacherous waters, we dodged some icebergs. But then you look at the market's reaction, a more than 6% drop. It's like they were listening to two completely different stories. And that disconnect is exactly what we're here to unpack.
Okay, so to figure this all out, we've got to start with the hard evidence. We need to look at the numbers from the report itself. So, let's get into the financials. All right, so the headline numbers, they're kind of a mixed bag, but you can definitely see the improvement. Revenue was just over $13 million, which is down a tiny bit, like 3.6% from last year. But, and this is the important part, look at the profit side. Gross margin is up, and their adjusted EBITDA loss, it got way smaller. I mean, they went from losing almost $1.7 million to losing less than $1 million this quarter. That is a clear move in the right direction. Now, moving beyond just profits and losses, check this out. They've been doing some serious work on their balance sheet. That negative 61%, that's how much debt they've wiped out just since the end of 2024. Think about that. They cut their debt from over $19 million down to just $7.5 million. That's a huge deal for cleaning up their financial house.
And the story on the demand side is just as good, if not better. This plus 31%, that's the growth in their residential backlog. And what's a backlog? It's basically future revenue that's already locked in. And get this, they grew it by 31% in one single month. July was just bonkers for them, mostly because customers were scrambling to get those federal tax credits. That's created this massive pipeline of work for the rest of the year.
Okay, so the numbers are looking better, right? The story's improving. With that in mind, let's switch gears and listen to the narrative management is telling. Let's see why they're so optimistic.
The CEO, Scott Maskin, he really painted a picture of survival here. He's talking about navigating through these huge industry collapses, companies like SunPower and Mosaic going down. And he's basically arguing that SUNation is still standing because they're different. They're not just a solar-only company. And they operate in these really high-cost energy markets like New York and Hawaii, which he believes makes them fundamentally stronger. And this isn't just talk. They've got a really clear three-step game plan. First, finish tidying up their own house with the restructuring. Second, fix the finances, which we already saw with that huge debt reduction. And third, and this is key, they're shifting their business model. They're moving more towards leasing and what's called TPO, or third-party-owned systems. It's all about adapting to how the rules of the game are changing.
So why the big pivot? Well, it's all because of this massive new policy shift. On the call, management even had a nickname for it, the One Big Beautiful Bill Act. Now, this new law is a bit of a double-edged sword. On one side, it's causing that huge rush of demand we saw in the backlog, because a big tax credit is about to expire. But on the other side, it creates a lot of uncertainty about how these projects will be financed long-term. And that's what's pushing companies like SUNation to focus more on those leasing models.
Okay, so this brings us right back to where we started. The turnaround seems real. The backlog is absolutely exploding. So, why on earth did this stock drop? What did the market see that soured the mood?
Well, the answer really gets into the weird world of microcap stocks. So yeah, their adjusted EBITDA looked better, but their official GAAP net loss was still pretty big, like $9.6 million. But here's the real kicker. Right before the call, they filed for a $30 million at-the-market agreement. For investors, that's a big red flag. It basically means the company can sell new shares whenever they want to raise cash, and that spells potential dilution for current shareholders. That almost always puts a lid on a stock price.
And you can see exactly how it played out on the day. The earnings call was pre-market, the stock actually opened a little bit up, but that good feeling just vanished. The sellers came in and took control, and the price just trickled down all day long, closing right near the bottom. It just goes to show you, for a small company like this, the fear of a potential capital raise can totally swamp any good news about the actual business.
So, that's the story of Q2. Now, let's look ahead. What really matters for this stock from here on out? Here's our take on what you really need to be watching for in the next report.
All right, for Q3, here's your checklist. Number one, and this is the big one, can they actually turn that massive backlog into real on-the-books revenue? That is everything. We'll also be watching for any news on their acquisition strategy. They've been talking about going after data centers, which would be a big move. And finally, we need to know if they've started using that ATM to sell shares. That's absolutely critical.
So what's our prediction? Well, you've got this huge backlog, plus the CFO literally said Q3 and Q4 are usually when they're off to the races. So we're expecting revenue to accelerate and jump up from that $13 million number in Q2, and if that happens, it should get them a lot closer to hitting their goal for the whole year, which is to actually be positive on adjusted EBITDA.
So, putting it all together, we're initiating with a market perform rating. Look, the turnaround of the business is real, you can see it, and that backlog is fantastic. But you just can't ignore the ongoing gap losses and the fact that they probably need to raise more money. That ATM filing hangs over everything. We think that's going to keep the stock stuck in a range for a while, at least until they can prove they can generate their own cash.
So when you boil it all down, you've got this classic battle. The business is getting better, but the market is skeptical because they need cash. The whole story now comes down to one question. Can they turn that giant pile of future work into cold, hard cash fast enough to grow without having to sell a ton of new stock and dilute everybody? If the answer is yes, then this stock is probably undervalued. If it's no, well, then the market had it right all along. This is not financial advice.